Following the exuberance in January and subsequent corrective actions in February and March, and now that we are into April and May, there's been a lot of speculation that the markets may have already topped in this cycle or are in the process of topping. And with the recent completion of the earnings season, I wanted to share some thoughts on market tops and analyze if the lessons of previous big market tops can be informative for our current markets. Let's take a look. First, let's look at the current situation. What made the first quarter notable was a strong outperformance of the Nasdaq versus other indices. Specifically, we can observe that the Nasdaq made a new high in March, while the Dow Jones Industrial did not. In the top portion, we have the Dow Jones Industrial. We could see that the peak was right here, if you can see my cursor, and we continued to decline from there. Now, in the lower portion is the Nasdaq. The Nasdaq peaked here. However, subsequently, after this fall here, it gained a new high at this point here in mid-March. Now, we've seen a similar constellation before, and if you're guessing the year 2000, you are guessing correctly. Not only did we see a similar event, but it also occurred during a comparable time frame. So now this is a chart from the year 2000, with the upper portion is the Dow Jones Industrial Average and the lower portion is the Nasdaq. And starting here with the Nasdaq, we can see that it first topped here in, say, early March and then reached a higher high in late March. The industrials, Dow Jones Industrials, hit their high in early 2000, declined, and then reached another point here, which was in early April, but this high was not as elevated as the previous high. So given the similarity, it seems that it might be fair to ponder the question if history will rhyme here. Well, these charts are not enough information, so let's dig for more details. One of the key technical patterns that you can observe leading up to a major market top is the weakening of the RSI reading. And staying in the year 2000 time frame, this is the 4-year monthly chart on the SPY or the S&P 500. The price chart is in the lower portion, and then the RSI oscillator is in the upper portion. Beginning here in 1998, you can see from this peak to this peak here, there's an upward trend, a correction, and then continuing on up here in 1999, another upward trend here, a small correction, and then beginning in early 2000, your last uptrend here. The market peak was either here or here in the S&P. Now, as opposed, taking a look at the RSI and these same market periods, looking at the peaks of the RSI, it was a slight downtrend here in 1998, another slight downtrend in 1999, and then the final downtrend here in early 2000. Also, taking a look at the RSI all the way from here in 1998 through 2001 is an overall downtrend. So the divergence there is significant. And beginning here in 1998, if you were paying attention, you would realize that you had over 2 years of an indication that there was a divergence and a potential market top. In this chart here, which is the S&P beginning in 2006, we can see a similar set of circumstances where in the price chart we had upward trends here in late 2006, early 2007, another increase here mid-2007, and then the last increase here in late 2007 leading up to the peak there. Now if you go on up to the upper portion of the RSI, again, you see a slight downtrend here, another downtrend here, and then your final downtrend here. And then, of course, this downtrend continued from, say, late 2006 all the way into 2008. So, similar set of circumstances that led up to the great financial crisis. And this is the current chart on the S&P for the last few years on a monthly basis. And as you can see, we're continuing on upward in the price chart. But with respect to the RSI, the question remains unanswered as this particular move isn't finished yet. So the RSI is on its way up, but whether or not it's going to be a negative divergence or not, again, that question remains to be seen, but this is something that we need to keep our eye on. Now let's go take a look at another perspective. And this last chart here showing the S&P 500 is a monthly chart going back to 1993, and it incorporates CPI data into the S&P 500 in the form of a ratio, and then they create these trend lines. So beginning here in about 1994, the trend line continued on up into the year 2001. Right at this point here, when it went below, that coincided with the dot-com crash. This trend line here beginning in about 2003 on its way up into 2008, and of course the market pierced through here, and then that was the great financial crisis, and here we are currently, this trend line from 2009 all the way up to the current time frame, and we're sitting about here. We have not pierced through the trend line. Again, that remains to be seen. So that's something that I'm going to continue paying attention to, and I would suggest that you pay attention as well. So for today, that's ChewDog Charts. Thank you.